Hi, today we'll be talking to you about hedge funds and the S&P 500 and our low concentration basket methodology, presented by Brett Weiss, Katie Kissel, Kim Gershkovich, and Ryan Mass. First, it is important to talk about the market efficiency. The efficient market hypothesis, EMH, is an investment theory that states that it is impossible to beat the market because stock market efficiency causes existing share prices to always incorporate and reflect all relevant information. Now, a little bit about hedge funds. A hedge fund is a limited partnership of investors that uses high-risk methods such as investing it with borrowed money in hopes of realizing large capital gains. It is critical to note that since hedge funds are not currently regulated by the U.S. Securities and Exchange Commissions, they can invest in many forms of securities. Hedge funds are a little bit more risky and are not always included in traditional forms of investment. Keeping the best interest of our research, we will be looking at the more traditional form of investing with a hedge fund within the stock market. It is fair to note that hedge funds often utilize long-short strategies. In other words, they buy stocks in the long position and simultaneously sell in the short position with borrowed money, followed by buying them back when the price is lesser. Next, we'll be talking to you about our low concentration basket strategy. Now that the groundwork is laid for the understanding of hedge funds, it is necessary to explain how hedge funds impact the stock market. We use an article written by finance editor Jeff Cox of CNBC, and he put it very simply: just own what the hedge funds don't. Recently, hedge funds have performed well compared to in the past years. Many analysts and experts have been trying to figure out why this is. One specific strategy, which is explained by Cox in the article, is that surprising hedge fund strategies are now beating the market, is the low concentration basket strategy. To summarize, this strategy consists of researching and owning stocks with lower concentration in hedge fund portfolios than others. According to the research, stocks with low concentration in hedge funds tend to perform better on average. Furthermore, the research shows that stocks with the low concentration in hedge funds are down just 4% compared to a 10% drop in most concentrated stocks. Next, we'll talk to you about the ways to beat the market with this specific strategy. In order to test this hypothesis with this article, Jeff Cox emphasized that stocks with the lowest concentration in hedge funds portfolios, as measured by equity capitalizations, have crushed the S&P 500 this year. And that's according to a Goldman Sachs analysis. This drove our research to test which stocks would be most beneficial compared to others. After learning this information from Jeff Cox, it became apparent that in order to view the effects of a low concentration basket strategy, it would make sense to conduct thorough research of each of the stocks Cox referenced and compare the low concentration stocks against the high one. Now, Brett Weiss will be talking to you about testing our strategy and the methodology.
Thanks, Kim. So, in order to test the methodology for the low concentration basket strategy, which was discussed in our research paper, we compiled data for 22 stocks, 10 of which were low concentration and 12 of which were high concentration in hedge funds. In order to do so, we extracted statistics from the Finance of Yahoo page. So all the stocks that we're giving, all the statistics that we're giving, have to do from July of 2015 to July of 2016. So we compiled the beta for each stock, the 1-month treasury yield, the Dow Jones change percentage, and the stock growth change in percentages. And then we calculated the expected return of each stock, similar to the capital asset pricing model quiz that we had earlier in the year. So once we calculated the expected returns for these stocks, we found something interesting, and that was that the expected return for the low concentration stocks were much lower, and the expected returns were very high for the highly concentrated stocks. And so this would lead someone to think, well, Cox's model is not accurate after all, since we would expect a low return on the lowly concentrated stocks. However, we also noticed that the betas for each stock of the low concentration were much lower on average than the high concentration ones. So in other words, the low concentration stocks were had very little risk compared to the higher concentrated stocks. Using this information, we realized that on average, the low concentration stocks were going to continue to make small amounts of returns, but they would be steady and they would continue to rise. Whereas our highly concentrated stocks, you might make some money or you might lose some money. And if you use the law of averages to kind of guide us in our methodology, we would notice that on average, if you invest in a diverse portfolio of stocks and invest a significant amount of money, you're going to make more money if you continue to invest in low concentration stocks, since you are more it's almost a guarantee that you'll make money off of your investment. So a few key takeaways that we can take from this project is that if you invest in low concentration stocks, you should expect to make money off of them, whereas that's not necessarily the case off of the higher concentration in hedge funds. So if you really want to beat the market, you have to consistently invest in economically resourceful, low concentration basket stocks. Now, we used our research to find this, and you can find our actual statistics that we calculated in an Excel document attached to our paper. But overall, this is the strategy that Jeff Cox proposed, and we actually found that his proposal was the right proposal. Thank you.